Hi, and welcome to another monthly market update. You're in for a treat today because I've got the wonderful Jen Lewis with Union Home Mortgage with us today. And she's going to be jumping in today and doing a lot of the talking, but I wanted to bring her in because there's been a lot of talk recently with what's going on in the mortgage industry. So Jen's here to share her expertise with us in the mortgage industry and how that affects the housing market. Of course, there's definitely a large correlation with what's going on in the mortgage industry and how it affects the home prices. So thank you for joining us.
Yes, thanks for having me.
Yeah, so Jen's prepared a little bit of a couple slides for us, I guess, to kind of go through just some of the talking points that we want to talk about today, but also just kind of give an overview of what the mortgage industry is doing with interest rates and how that affects people's buying power and all that fun stuff. So Jen, why don't you jump in and I'll just kind of, pick your brain and ask questions as you go along.
That sounds good. Well, thanks for having me. I'm Jen Lewis. I'm a loan officer with Union Home Mortgage, and I live here in Grandview Heights, Ohio. That's where we are now. We're at an Airbnb that Ryan helped my mother purchase.
That's right. This is a lovely space.
Yes. Yeah. So thank you, Ryan, for being such an amazing realtor and helping my mother. So but yeah, I would love to start off by just sharing with you a little bit of the real data about what's been happening with mortgage rates, especially over the first quarter of the year, because as we all know, rates have been historically low the last couple years. Specifically, 2021 was our lowest year in history. We've been recording interest rates over the last 50 years, and 2021 was our lowest year to date, being 2.96%. So what we've seen over the last couple of years is a lot of people refinancing into a lower mortgage, lower payment, lower interest rate. And we've seen a huge increase in the amount of people wanting to buy because they can afford it, right?
Makes sense.
So I have a slide that shows.
Let me share the screen so we can pull that up.
Yeah, perfect.
Bear with me. There we go. Hopefully everyone can see this. Make this large so you can see it. There we go.
Yeah, perfect. This shows the interest rates for the last 4 months. We're going to wait here since it's June 2nd and see with the results from May. But what we're looking at here is going from 2.96 on average in 2021 to just under 5% at the end of April. And you can see that's just a huge increase in a very short period of time. So I think that got a lot of people scared.
Yes, rightly so.
Yeah, a little bit. And what's going to happen? And, is there going to be a burst and all kinds of people just speculating, lots of predictions out there of what's going to happen. But what we've seen over the last couple weeks, just to kind of tell you what we've seen in May, is we have seen mortgage rates get into the 5%. We're in the mid 5s. But they have been pretty steady. They've fluctuated a little bit here in the last couple of weeks, but they've been overall pretty steady. Okay. Maybe our investors are above 6% now, but our average 30-year fixed primary residence buyer is still in the 5s.
Yeah, that's the question I get a lot. Is what are we seeing in the mortgage industry right now? So you get that about every other day.
Yeah.
So it's good to hear.
Absolutely. And to see how that really affects your payment, that's where I feel like I would want to talk to you one-on-one. We can run some numbers to see how the interest rates are impacting you from an affordability standpoint. But if you want to skip to the two slides, the next one there. Okay. This kind of gives you, I'm sorry, the next one after that, we can go back to that if we need to. This actually gives you a little bit of an overview of the history of interest rates over the last 50 years. You can see our highest year on record was in 1981 with 18.5% as at that record high interest rate. Yeah.
I think that's what my parents bought. So I know. They always tell me the horror stories about that.
That's what I hear.
They got a great deal at 17%.
Yeah. They're like, oh, you kids don't even know higher rates, right? But we're looking at that has been a long time ago for a lot of us. A lot of us who are purchasing now, we didn't purchase during those times. So as we are starting to see them creep up to the high 5s, it does make us a little nervous because we haven't seen them in the 18%, so but when you look at this chart here on the bottom right, it's going to show you the median, the average rate over that last 50 years, which is averaging at 7.78%. So being in the high fives right now, we're still below that average, which is a good thing. We don't know really where they're going to settle in or if they're going to just continue to change, but what we're seeing there is an average of 7.78 over the last 50 years. Yeah, so that's kind of just a quick overview. I could dive in even more if you'd like, but what are your thoughts?
That is
questions?
great. Those are the things that I wanted to kind of clear up and say. Now, I know we talked a little bit about this before we started the video, but the biggest question I like to follow, and I talk about markets. Stop sharing here. When I talk about markets, people keep sharing all this stuff, like the horror stories that this is happening, that's happening. We're in for a crash, and everyone has their own opinion on what is going to cause that. And when it comes to the housing market, one thing I want to kind of just clear up is that the economy, yeah, it impacts the housing market, but it's not the only factor, and it's more nuanced than people really understand it to be. It's not just prices are increasing or interest rates are increasing. I think in fact, I've seen that interest rates going up has never historically caused pricing to drop in housing. So not to say that it can't drop, but it's just there's not a correlation. It's not a cause and effect. If interest rates go up, all of a sudden prices go down. And so, but the real factor that drives markets are buyers. Buyers are the really, buyers' willingness to purchase property. It's kind of a very obvious thing, but people don't think that way. They think that it's just based on the economy, just based on pricing, but it's really buyers' willingness to purchase. And the reality is people need a place to live. Even if prices are high, interest rates are high, what we think is high here in Columbus is super steep in San Francisco. And so people eventually, they still will live somewhere. And people, also get married, they get divorced, they have babies, they, get promoted, and they get fired. Those things are always going to happen in our lifetime. And those are really what causes markets. And in 2008, everyone's, comparing this market to a 2008, thinking we're going to, when we build up, it has to just burst. And that's not the way the market really works all the time. We don't just always burst. Now it happened once, so it doesn't mean it can't happen. It happened in 2008. And I don't think it's going to happen this time. I don't know the future, but
there were definitely other factors contributing to that burst that are not playing into this.
We're not seeing the same kind of market now. What I would say is there's still plenty of people that need to live somewhere. And last year, even though we had a record number of sales in the industry, in the real estate world too, 2021 was our highest recorded year since 2010 in record number of sales. And we saw that with the mortgage industry, with interest rates being low as one of the main drivers. We still have a lot of buyers out there that need a place to live. And last year, actually, even though prices increased at a dramatic almost 15% in Columbus, rents actually increased higher last year. And so eventually people are going to say, even though rent's going to go up as well. So people who are renting are going to say, I can still buy a house for the same amount of rent. And they're going to want their own space. So those are big factors.
What I always say too, I mean, life impacts whether we need to buy, right? So you kind of mentioned that we move, we get married, we relocate due to a job, we get divorced, we have babies and need to expand. Like there's so many reasons, right? So, oftentimes I use the analogy of, when you need gas in your car, you're pulling into the gas station to fill up your tank, and you're not really, gas prices are what they are that day.
And they're high right now.
And so are mortgage rates. So, so it's like, you kind of have to, buy according to the market and where things are. And there's always that opportunity to refinance if we ever do get back into that environment we were in the last couple of years.
That's a good analogy. Like we'll probably have a few less people on the road because of gas prices. People will think twice before they do the road trip now. But there's still people driving. There's still plenty of drivers out there. We still have people have to drive to work. They're still going to go on vacation. It's just going to cost a little bit more. And people understand that. So that's a great analogy. I think I never thought of that way, but just because prices go up doesn't mean that people stop driving. And that's the same thing with the housing market. Just because prices go up and interest rates go up doesn't mean people stop living in homes
Right.
or wanting to buy homes and purchase homes for themselves. But the big factor, though, is another huge factor that we haven't touched on is the investment side.
Mhm.
With the stock market doing what it's doing right now, it's not people aren't just rushing to put money in the stock market and traditional forms of investments.
Mhm.
And with inflation rising, housing is actually a great option to hedge against inflation.
Yeah.
So that's another thing that's actually going to keep this idea of this bubble from bursting is actually investors putting money into the market and into the housing market and not the normal markets. And now I do think we're headed for, I think almost every economist thinks that we're headed for what would be considered a technically in a recession, but more of a mild recession, where prices may happen to the GDP may happen to go down, but that does not affect the housing market one-to-one either. So so this the reason I want to do this video today is to give people an understanding what's going on in the market, what we're seeing as industry leaders, but also to say, one, we can't predict the future, but what we're seeing is not 2008. It's not that,
Right.
but at the same time, people are going to pause, I think. And I'm calling, I'm having a lot of conversations with people right now, and I'm calling this almost an inhale in the market right now. I've actually seen a lot more. We've seen, the inventory has gone up, but it's gone up very slightly. And, the number of homes being sold has gone down, but we had a record year last year. So it's kind of to keep those paces have gone down. But the flip side of that is that builders have actually not built as much. So we're not building more inventory. And I saw Columbus was one of the few metropolitan cities that actually gained population during the pandemic, the last 2 years during the height of the pandemic. And so we're still, that's metropolitan, that's not including the suburbs and the outer. So those are definitely creating a lot more population. And so we're still seeing an influx of people in Columbus with not an influx of building. And again, kind of back to this, the market and how buyers, really influence the market. It's simple supply and demand. So.
Yeah. And I do have a slide on inflation. You could pull it up if you want. Inflation right now is at 8.3%, which is way too high.
Is that
that is high. We want to be below 2%. That is slide. Yeah. Yep. You got it. So you can see there, this shows you since 2012, over the last 10 years, what the inflation percentages are or have been and what they currently are. So we're at, in 2022, we've been at 8.3. And so the Federal Reserve, they don't have a direct correlation on increasing mortgage rates. Our mortgage rates are determined based off of mortgage-backed securities and the supply and demand of those mortgage-backed securities. But the Fed has been a huge buyer of these mortgage-backed securities, so they do have an impact to interest rates. It's just not a direct correlation. And what they're trying to do is they're trying to reduce inflation. And so that's why their method of increasing rates, they're hoping that will decrease inflation. But to your point, is that going to have, the impact that we really need? I don't know. But that is one of the reasons why we have seen rates rise is the demand for these mortgage-backed securities has changed. And the Federal Reserve was a huge buyer of these mortgage-backed securities, and they're not buying them anymore.
Yeah, that's a good point.
Yeah.
Thanks for sharing that.
Yeah. Of course.
Sure.
I think we also are going to start seeing mortgage companies getting really creative on the products that they're offering outside of that conventional financing. I think we're going to start to see some of those non-QM mortgages. We might see some opportunities to lock in a rate now, or to those adjustable rate mortgages might be coming back. So we're going to probably start seeing some different products being offered to the consumer. Yeah,
I saw some of that too in the news. More creative options, even longer. They may even go to a 40-year fix. I've heard people throw that idea out there where it's, it's longer term. It's less payments. Because people ultimately are buying a payment. And if you add another, obviously you're going to be paying the interest and all that a little bit longer than not buy it, not have as much equity as quick. At the same time, it helps people get into homes and stuff like that. So I kind of where we go from here is kind of what what I'm seeing, and Jen, I think, is in agreement when we were talking, is what the next few years looks like. If you're looking to buy or even sell your home right now, what's going on? Let me get, can we give you confidence to do that or not? Again, we don't have a crystal ball. We can't predict the future, but everything I'm seeing, it seems to be like we're headed for what I would call a slowdown in the market.
Mhm.
And I kind of feel, again, we're kind of in an inhale where people have like stopped like a little bit, like just all of a sudden drastically was a little bit of an inhale of like, but part of that's because we just left, in May. This all happened a couple of weeks ago in May. We just transitioned from the spring market, the spring frenzy,
Mhm.
to the summer market.
Yeah.
People are making summer plans. They would rather, instead of hunt for a house every hour of their free time, is they're starting to talk about vacations and want to go on vacation. So they may have made a plan to just re-up their rent, their lease for another year, and say, let's re-up our lease and focus on summer, have fun. We'll hit it. We'll come back to this in 6 months. We see a lot of that this time of year. We see a lot of people just get tired and fatigued, and we see a lot of the very, very desperate buyers make the very, very desperate offers and actually get into houses. So we're starting to see that slowdown, but this is a normal slowdown in the summer. But I think we're seeing an extreme case of spring market to summer market, but with prices increasing, and the cost of purchase increasing significantly the last 3-4 months because of prices and interest rates combined, make it difficult for buyers to swallow that what you could have paid for, an average, let's say $300,000 home in Columbus is all of a sudden up, monthly, maybe a couple $100 in your payments. So
it's very true.
So I guess moving forward, what do you kind of see with the interest rates and kind of how that affects the markets and buying power and all that?
I mean, I think we're going to start to see a lot of different things. I think we're going to see non-QM mortgages.
Okay.
I think we're going to see, to your point, like, are we going to go to a 40-year? Are we going to have some creative structures? Are we going to have buy down mortgages or adjustable rate mortgages come back strong? So it'll be interesting to see over the next couple of months what happens there. I know a lot of companies are allowing you to lock in for a specific period of time, whether it's 90 days, 180 days, lock in now, in fear that they're going to continue to increase. But I always like to work with my buyers on working with their budget, because let's work with what you feel comfortable with from a housing payment, and let's structure everything around that. And even if we can structure it where we're just slightly under budget, then maybe you can put a little bit more money towards your principal each month. So you're truly not paying that rate. You know what I mean? Like, let's be creative. Let's put an extra $50 towards your principal each month. So that way you're really not paying that 5.75. You're really paying.
I think people got lazy almost the last few years in that sense, as because you really didn't need to worry about that. Your money was so cheap. So just, get as high as loan as you can, and don't worry about extra payments because you pay off everything else.
Right.
But now we're getting back to the, when I bought my house, it was at 5%, and I wasn't balking at the interest rate at all. But, and of course we were the ones that refinanced at some point too, but, and that's, which the point we didn't touch on is the refinance industry. We can go a little tangent on that, I guess, right now, is that the refinance industry is really what's going to, with the mortgage industry, and the numbers are going to seem kind of crazy that all of a sudden, a lot of mortgage industry has really relied on that refinance business. And, you didn't have to worry about, let's get creative with home buyers because interest rates were so low, and you didn't need to, there's no reason to. And so now I think it's going to be, you're going to need to be a good loan officer. You're going to really stay in this market and get creative and actually interview people and say, okay, how do we make this work for you and stuff like that. And I think that, that's the important, reason to have a good loan officer as well.
It's not just, how much can you afford? It's let's talk about your budget. Let's really talk about how we want to structure this. And, I just started a loan application for a buyer yesterday. We put her in a 20-year mortgage because her interest rate was an entire percent lower than a 30-year. And she had a little bit more cash reserves that we put towards her down payment. So her interest rate is actually really great. Her payment is well within her affordability. And she's planning on putting that extra money towards her principal each month. And I think it's just about structuring it for your family in a way that's going to feel affordable. You're not overextending yourself, and that you feel like you can repay that mortgage and really, honestly, right now, depending on your purchase price, that you might not feel the rate too much.
Yeah.
You know, you might not feel it, the increase in rate. So I think running the numbers, I feel like it's one thing to say, interest rates have risen, and it's like this big scary thing. But have you really looked at what impact that really makes to your monthly payment? Because maybe it's only $50 a month, and does that have an impact to your monthly budget? $50. So
Yeah.
let's look at that together. We'll dive into some numbers and really break it down to see if it is something you should be fearful of. Because I really think in most cases, we find a good solution for our buyers.
Yeah, I agree with you there. So to recap here, I think moving forward, I think that, I'll be surprised if we sit here next year and say prices have decreased. Now, I don't think they're going to increase at 15 to 20% like they have last 3 years, essentially. Yeah. I think we're going to head back to, if you were paying attention at all to like what it was like 2015 to like 2019, where it was still, no one was calling this, a buyer's market by any means in 2017, 18. But there was, the nice homes that everybody wanted flew off the shelf. But if your home was, dated and needed work and had issues and had problems with it, then it took a little while to sell. And if it was on the high end, it may have took a little longer and stuff. So, but with that said, I think right now, there could be an opportunity for buyers because people are kind of, have just pressed pause on their stuff, whether right or wrong. And all of a sudden, I think there's an opportunity almost right now in the next month to really, if you're a buyer that has been looking and just, put on the sidelines, maybe reconsider and say, well, maybe there's an opportunity right now to get something, as everybody else kind of is doing the same thing. The flip side of that is that, there could be a reason everyone's sitting on the sidelines. So there's some risk to that. But I mean, March 2020, everyone said timeout as well. And then we saw what happened after that. Things just flew off the shelf. And if you bought, I had a buyer get in contract the day of the lockdowns, and I'm, I was nervous myself when that happened, but I'm grateful that they did, because after that, it just, obviously it was even harder to find a place. So you never know what can happen, obviously, but there could be opportunity right now, or it could be time to sit on the sidelines. So it really depends on your comfort level and what you can afford. But the downside is I don't predict prices to go backwards. Maybe where do you predict interest rates? If we going forward, if there's a way to predict it.
I know I would have said something different probably 3.5 weeks ago. I don't know. I think we're probably going to settle in somewhere between 6 and 7%. But I don't know that. I do think, looking at historically, if the average is 7.78, I mean, maybe somewhere between, 6 and 8%. That could be at.
And it's one of those things we're balking at the idea of getting close to the average. We're not talking like, extreme, numbers here. We're talking close to the average. Now it does, when you get used to, 3%, 3.5%, it is hard when you get spoiled with that. To all of a sudden realize that you're going to get close to the average, number at 7. So I get that, but at the same time, these aren't, panic. Now there's a lot of factors going on in the market, and there's a lot of factors going on in the economy right now that, if your comfort level is not, if you're not high risk, if you're not, you're really risk adverse, you may want to sit out right now and just kind of see. But I think the next 3 months, 2 to 3 months will be a huge sign of where the market's going. So we'll know pretty soon if we're headed for more price decreases on average. Things, I think we're going to see price decreases in list price, but will the actual sold prices be lower than what they were year over year? I'd be surprised.
That'd be interesting to see.
So
I do think you're right. I think Q2 is going to be a telling time into Q3. I mean, I think we're gonna see a lot of shift in the numbers and in our market, but I think we're still in a good spot. I think we're still in a good spot. I don't think there's anything to be fearful of. And I know that, we're in a completely different atmosphere than 2008 when the crisis happened, the housing crisis. There was a lot of different lending practices during that time that contributed to that. And I will tell you, those do not exist today. So
still pretty stringent. So, well, thank you. This has been great. We didn't even talk about the, one factor, that population growth a whole lot with Intel. I still, the Intel population coming here now. It's a 10-year project, so it's going to be some time, but I do think it's going to make an impact as well. But thank you for coming. This has been great. We should have to do this more often. Again, Jen Lewis is a lender extraordinaire here. So if you have any questions, obviously feel free to reach out to her, and we can tag your information in the notes here. There's also some helpful information if you want to learn this information yourself. A couple of resources is the Mortgage Lending Association is a great. They do a lot of tracking on mortgage applications and all that stuff, and that's really what I pay attention to when it comes to what's coming down the road for the housing market. How many people are applying for loans? How many people are out there? You mentioned that you have a lot of people still pre-approved that are looking, and you can see data for your whole company, and there's still a lot of buyers out there. A lot of people that want to be in homes and are having a hard time getting in them. So
it's still a good time to sell. Still
a good time to sell if you have a good house. You just can't put it on the market and sell for 20% higher than what you listed at. There's got to be a little bit more of a strategy right now, and understanding it's vital to get top dollar. So anyways, well, thank you for tuning in, and as always, if you have any questions, you want to learn more about your neighborhood or your house specifically, real estate markets are always, of course, local. One street can make a difference to the next. And so, making sure you have somebody that can help you understand what your home is valued at, and understand what your assets worth as well, and or just want to know what's sold in your area. Always reach out. I'm happy to help with that and kind of give you an individual number. Same with Jen. If you need any help with that, I'm sure she's more than happy to kind of make an individual plan for you. So thanks again, and we'll do this again for sure.
Absolutely. Thank you.